into economic prospects in Kenya at the moment. I mean, the performance of the shilling as we're seeing it play out at the moment, many saying that they expect it to firm over the first half of 2010 on the back of economic growth prospects. But of concern, and specifically being highlighted by the IMF, is monetary policy framework in the country that needs to be revised. So let's talk through developments there, and if it could well be hindering economic progress in the territory right now.
Well, yes, I mean, part of the issue is that the transmission mechanism from central bank intentions through to actual lending rates in the economy just simply aren't happening as they should. So, I mean, to start off with, if we look at what's happened to the CBR, we saw the CBR was left unchanged at the last meeting. What does that mean for treasury rates? Well, we've seen treasury yields decline. They've come off quite nicely. And at the current level, I think the question could be how much further can they decline? And I think probably not much. This is what the central bank wanted to achieve. They have achieved it. And now the question is they want to see those lower rates filter over into lending rates. And this is what is not happening at the moment. And this is where the problem is. So what actually happened in the monetary policy statement is that they've highlighted, in fact, there was this odd request for banks to come up with ways of how are we going to get the central bank rate to feed through to the lending rates. And we can sort of see the context because on Thursday, the IMF released its country report. And in that country report, they essentially said that the monetary policy framework is not as good as it should be, and it needs to be changed. And so essentially, it seems like you have a central bank here who've set themselves a few targets. They've got the central bank rate lower, they've got the treasury bill rates lower, but they have not got the lending rates lower. And this is what I think over the next year is going to be the focus. And not only in Kenya, for incidentally, I think this is a theme that we'll see in a number of countries where the focus is going to be how we're going to get banks to lend at lower interest rates.
Let's take a look at economic data that filtered through yesterday. We saw January's inflation data reveal that consumer inflation dropped to 4.7%. I mean, what did you make of that? Are we now expected to believe these figures according to the new basket?
Well, I think that a lot of people have looked at the old way of calculation, and the new way of calculation is strongly supported by the IMF. They've now adopted a global norm. There's always questions about how representative is the basket, things like that, but that's not really the issue. The issue here is that the current inflation number is probably more reflective of the actual situation, because even if you compared Kenyan inflation, particularly Kenyan food inflation, to regional food inflation, it was all over the show. And you did not see the same types of moves in Tanzania and in Uganda. So one always had the sense that there was something wrong with Kenyan inflation, and I believe now it is probably better. Yeah. Now, in the short term, it doesn't look like there's any inflationary pressures in the system. We've got base effects which will keep food inflation low. The demand side of the economy is very soft. I mean, we were talking about credit extension and lending rates. Credit extension has dropped down something like 10% from what was about 30% a year ago. So the demand side of the economy stays soft, right? And hence why I don't think that there's huge room for the central bank, to be hiking anytime soon. They're going to be focusing on that. So, no, I think in the short term we're probably looking at a pretty much a status quo. The inflation data is supportive, and I think things are looking okay.
Leon, let's leave that discussion there and bring in Alice Wambugu, who's an investment analyst at CFC Stanbic Financial Services. Alice, good morning, and thanks so much for joining us. We're going to shift direction from that broad economic picture to look at the markets that are, of course, operating in that context. What are you making of some of the movement we're seeing on the NSE at the moment?
Alishia, I would say that for now what is happening is that investors are booking in gains. If you looked at our market, especially in the first 2 weeks of January, there was a bit of a rally, and most of the counters gained considerably. And what investors are doing right now is booking in gains, although this has prolonged for about 2 weeks. But I would say if you look at the supply-demand situation on almost all counters, supply exceeds demand by far much more. And I would say that it's just a situation of profit-taking on the counters.
It's at a time also when we've got a lot of the local investors keenly tuned to some of the news and company news that's driving momentum right now. Mumias Sugar, for one, up 20% in yesterday's session. One would assume that on the back of its results announcement on Friday last week.
Yes, that was based on the results announcements, and also because the 10% rule was relaxed, so there was an opportunity to go way above the 10% margin that they're required to trade. And again, for Mumias, they posted good results, although that we might not have seen it so much on the top line. The revenues only have gone from about 6.2 billion to about 8.9 billion. But if you look at the net income, it has grown by about 560%. That would tell you that the big profit margin is not really coming from the top line, but probably from a one-off. But since the company did not give specifications as to where, they didn't give a lot of information as to where this profit came from, it's a bit difficult to tell. But yes, the 20% gain that we saw yesterday was because of the good results.